Hi, everyone. It's SF Education again. Today, our guest is Bernardo Uribe. He is a seasoned business professional, actually works as a vice president of operations at Credit Star, which is a fintech company headquartered in Estonia. And today, Bernardo mainly is going to talk about disrupting consumer finance with technology. Bernardo, welcome.
Thanks a lot. Thanks for having me here. And happy to have a discussion.
Yeah, can we just start off with you talking about yourself for a short while, and then we'll continue with our main topic?
Yeah, for sure. So very briefly, I'm actually originally from Ecuador, South America, and started my career in actually heavy asset environment into oil and gas for 5 years, then had another like 5-6 years into entrepreneurship, and eventually exited one of my business at that point, went into LSE, got my degree in global management, and then went into technology. So I spent the past 6 years in between different technology companies, namely into 1 year in venture capital. Then I did 2 years of delivery hero, so food delivery marketplaces. Then went into Bolt in Estonia and did another 2 years. And lastly, but not least, I'm working, as you said it already, as a VP of operations at Credit Star, which is a consumer finance company based out of Estonia. And my role is mainly related to managing the different countries and make sure that the operations are running smoothly.
So what brought you to fintech? You had quite a diverse career and selection of industries.
I think good question. I think it was mostly I wanted to see what was actually fintech all about. So obviously it's a huge market, so that brought just a lot of the awareness and how big this is, and how this today is actually the time where all of the things are being disrupted. Like you think about all these consumer finance applications and all of that, but what is happening beneath and all this, we're going to talk a little bit about machine learning today and all of those. It's really sparked my interest into how this could evolve. So I think I was just practically very interested in the space because it's so big as well. So that kind of made for me the switch from marketplaces technology to fintech.
Okay, so in a nutshell, what are we going to be talking about today?
Yeah, so I'll walk you through a little bit about how is it that technology is playing a pivotal role into disrupting consumer finance. So think about what is happening beneath, what you see in the typical environment. So all the things that are moving, all the technology that is moving and reshaping how consumer finance was usually seen many, many years ago to what it is today. So it's pretty much talking a little bit about all these important parts that everyone kind of talks about it, but nobody really knows too much about it. So think about data science, machine learning, all of these algorithms and how do they work. So this is pretty much what I'm going to talk to you guys today.
Yeah, so that sounds extremely interesting. So let's start off then.
Yeah, cool, thanks. So in a nutshell, so consumer finance, what is basically is, or how it was envisioning historically, is kind of like a division of retail banking, primary dealing with lending money to individuals. So think about literally banks lending money to people. So this is historically what consumer finance is. And of course, you have many of these lending processes, right? So think about consumer lending. So people want to get regular loan, 500, 1,000, small loans, bigger loans, etc. Then you have mortgage lending, credit card lending, issuance, and so forth. And then all of the payment and merchant services. So think about B2B lending as well. So this is what consumer finance is in a nutshell. And the way it was seen is that historically, all of this process to give out a loan, if you think about it, were very slow. So think about one person wants a loan, goes to the bank. Literally, the bank, what it was doing in that point, sorry for this, what the bank was doing is analyzing all the paperwork and then trying to understand the patterns, whether this individual could actually receive a loan. So think about payroll, all of these data, and they put together all of this, and they analyze it, and then eventually they decide whether they give out a loan or not, right? So this is kind of like historically how it has worked so far. So it was a very decentralized process in a way that there's no centralization of data. It's like people are just analyzing linear data. So think about one payroll, one person. So these were not really patterns that you were looking at, but they were like very decentralized from person to person and so on. And of course, they were heavily time consuming. So this literally, how it was done, it was like literally people reviewing applications and all of that. And then on the customer side, you needed to put all of these things together. So I don't know if people that are hearing this conversation that were born in my year, which was like in the 80s, then you still remember how these consumer loans were typical made. You need to do a lot of paperwork just to get one loan. So that was like how this was done in the past.
And you would also probably go to a few different banks, and this process would be similar in each one of them.
So
they didn't share data with each other, I would assume.
Yeah. So I think that's also something that is changing a lot, right? So you think you today, you think about open banking, right? So this is pretty much all this data from different banks or from different consumer finance companies going to one centralized data warehouse, and then everyone can actually use it. So now what has happened on the past that you had to do, like as you said, like one bank, you paperwork for that specific bank and so on and so forth. Now it's taking a different shape as well. So what is the opportunity, right? And this is what like really sparks my interest. So the cost of risk is one of the biggest components in the bank's cost structure. So cost of risk meaning the ability for a person to repay the loan or not to repay. So you think about default rates, right? So default rate would be one specific topic that will pretty much impact your biggest cost. So because this is so important, institutions spend a lot of time trying to analyze and look for patterns and look for ways in how is it that we can improve it, right? So they think about what are the different trends on a specific individual that makes this individual repay one specific loan or not. And that's huge. And so eventually institutions, so think about banks and also consumer finance companies, ended up understanding that even a slightly improvement in this risk modeling in order to assess whether an individual could repay the loan, it's massive. So if you were able to even slightly improve this model, then you will have massive returns. And this is specifically how it all started. And that's why, specifically, for example, machine learning and data science was very early started to be implemented in consumer finance. Like we've seen that these trends have been implemented from like literally very early days because the cost savings were massive. And then what it's even more interesting is what I call kind of like the flying wheel, right? So if your costs are less, just to understand how much is it that you can actually, how much, if the costs are less to understand how the individual could either receive a loan or not, then you can pretty much pass those savings into the customer. So think about now you have like dynamic pricing, for example. This is something we also have in consumer finance. So there's specific pricing for a specific individual depending on the risk. And the only way to actually assess that is by having all of this data infrastructure.
So how long ago did this trend start in using data science to do this? I would imagine it's called scoring models. Was it like 15 years ago or no?
Good question. Not quite sure when it started. What I can tell you is that it was very implemented on early days. So when even people were not even talking about machine learning in some different industries, they were already trying to do something in this consumer finance space. Because as I said, like the savings were massive. So this already started quite early. But yeah, I'm not quite actually sure when and who was the trigger, but it was from early days. So what is technology doing today? Pretty much. So it's pretty much changing the way the industry operates, right? So when we talk about technology, how is it that affects each of the different industries? I want to bring you a few examples of how technology has shaped here the different things. So statistical models have made these decisions incredible fast. So when we were talking about the old structure where you go and you actually put up a loan, and then you need to bring all this data to the banks, right? So this is pretty much not happening anymore, right? Like what it's actually happening today. Yeah. So what I was saying is, what I was saying is regarding these statistical models has made the decisions engine incredible fast. So what it took like some time ago, let's say 1 week, 2 weeks to analyze, today is done in literally seconds. So when we think about consumer X wants to have access to a loan, then they go into a website, for instance, they take out the loan, they make their application, and all of this data is gathered in the same way and sent to different decision engines. So the decision engines, what they do is pretty much they analyze all of the data that the consumer is giving us, and then in matter of seconds, they actually understand whether the consumer patterns are either good or bad in order to reject or accept the loan. So all of these algorithms, all of these decisions engines have made our life incredibly easier compared to what it was done in the old days. And then talking about data science, this is where it gets like really, really, really smart and good. So artificial intelligence now can predict different patterns. So they don't only understand historical data, but all of these data science platforms now are able to understand from specific patterns whether a specific individual will be able to repay or not repay the loan. And so you think about now different patterns. So ages is, for example, one. Like there's specific patterns on people's age. There's specific patterns of people education, specific patterns of people working in specific industries. So all of these is what we're calling now kind of like artificial intelligence. There's a lot of machine learning, which is pretty much the systems are actually becoming better and better in time. So not only do they start with something, now they will, the more you advance and the more decisions have been made and look at the different outcomes, the more the systems actually become better at what they're doing. So this is what we now call like artificial intelligence, machine learning, which these models are able not only to predict what is going to happen with specific individuals, but they are able to learn from all the data they've looked at it and analyzed and then get together. So it's like, it's a process that it's not only good, but it's just becoming better and better and better every time they actually go and they actually do make more decisions.
So I have a question. Do these systems work by themselves, or are there like data scientists who on a daily basis
go in
that's
a good question
and do tests and whatever?
And I think it's a good question. So I think there's a few things, right? Like we talked about briefly about open banking. So what it is, for example, is there's a specific platform that just gather a lot of data from different sources. And so these are kind of like open, that's why they're called open. So you can literally just access the data, retrieve the data, and make some decisions. And there is like specific platforms that are just, think about decision engines. So if you go to one specific market, if you go to the UK, for example, there'll be plenty of companies just that can give you this data. I think what is important and what data science teams internally do, so think about our data science teams in the company, what they do is they need to figure it out. What are the most important platforms to be used? And then how do they unite them? How do they unify them? So you can use, for example, 2 different platforms, 3 different platforms for one specific country. And then you will take all the data for all of these different platforms, and then that's how you make your decisions. So this could be one thing. The other thing is like you can literally build it up. You build up your different scoring models, scorecards and everything, and then you can like understand how is the user behavior and so on. So in short, there's no one size fits all. There's like open platforms and there is like self-made platforms. Obviously, the trade-offs are that if you want to construct your own platform, then you need to do a lot of engineering work. So I guess it depends on how much time and resources you want to spend into it.
So, sorry, final question on this slide. So these platforms, right, they can only work if in the country that we are talking about, there's like a number of databases. And you connect to them somehow. How is it done, for example, in emerging markets or like Africa, countries like this? Is this something
So
that is a hindrance to the development?
Good question. So in short, there is different actually, when you look at like let's call them for now like more advanced markets, more mature markets. So you have laws that pretty much, there are certain laws in different markets that you need to send out the data for the customer. Like you need to, if you are a consumer finance company, you need to send it to third parties platform. So that way it becomes more open. So that's why in certain countries, this is much more advanced, because then all the data, everyone needs to share. And then the platforms, they pretty much, you don't need to make a decision out of it. You just need to share the data. And so we have to share data from some of our customers in different markets. When you look at about like third world countries, it's much more complex. And that's why when you think about the outcome, so the interest rates is much more higher in third world countries. And the main reasoning is because it's riskier. And so if you're able to decrease the risk, then you're able to give out a lower interest. And this is the flying wheel I was talking about. So the only reasoning of why there's lower interest in like first world countries is because the risks are lower associated to giving out the loan, while in third world countries, because there's not much data,
there's more information,
then it just becomes,
which helps it, which helps
exactly
the risk. Okay.
Yeah, exactly. So yeah. Anyways, and then a little bit about machine learning. So pretty much something we try to talk a lot about is acceptance rates, right? Like, so you, in a perfect scenario, you want to have 100% of acceptance rate, meaning that you are giving out the loan to everywhere. Like if somebody comes out to want a loan, then you want to give it out. The question is, who do you need to give out the loan? And this is the riskier part, right? Like, so you want to give out loans to people that are going to repay. And the only way to give this is understanding what would be the acceptance rate. So what machine learning has done over the past years is figuring out these models in which you will gradually decrease the risk, meaning that you want to optimize for higher acceptance rate, but you also want to make sure that you don't have a low default rate. And something that has really sparked my interest over the past months and years is what we were discussing about kind of like targeted interest rate. So now, as time goes by, in the past, you went to a bank, you had a standard, let's say 10% interest rate. Like everyone had 10% interest rate. Now today, what machine learning has been able to do is that because they understand what could be the default rate for each specific person, then you can have like individual interest rate per person per risk. So that makes incredible opportunities for everyone, right? Like, so if there's a certain group that were not able to get loans because they were riskier group in terms of default rate, now they can actually get it, but they will just have a higher interest. And if you have a lower group, which more or less risk to have a default rate, they will also benefit from it and actually get a lower interest rate. So that's pretty much what machine learning has done over the past few months. So the amount of improving the acceptance rate while decreasing this default rate, which means like a bad portfolio.
So basically, they're using like a portfolio management approach. So if investment companies do that with, let's say, like equities and bonds and other financial instruments, banks do this internally for their like loan portfolios. So this way you can actually like diversify and grow the portfolio and earn the return. Can you just explain a bit the graph that we're seeing on the screen? This looks really interesting.
Yeah. So pretty much what it's a way to understand it here is, so you have these blue dots and red dots. So you have this regression scoring model, and then you have this tree-based scoring model. So you have pretty much two models. One is X, one is Y. So these two models, and what you want them to be is this correlation. So what you want to see is where you have red and blue dots at the same time, it means there's kind of like a correlation on how these two scoring models work. So pretty much what you want to do is have as much as green and red dots together so that you can actually have lower risk. And then the more it goes, the higher the acceptance rate. So it's pretty much from 0 to 1, and then you want to have those pretty much correlations between two different models, and is like so important. And there is like plenty of models, right? Like you have like the regression scoring model, that's one, this tree-based scoring model, but there's like plenty of models out there that you can use and just try to understand what are those correlations between one and the other. And pretty much what you want to have is a lower portfolio risk. That should be your always kind of the goal, is to have a lower portfolio risk while increasing this acceptance rate, right? So of course you can have a 0% acceptance rate and then no risk, but then you're not accepting anything. So these scoring models work in the way that you kind of like decrease that risk.
So what does a portfolio risk of 0.75 mean exactly?
Yeah, that's pretty much, it's kind of like, think about 0.70, like one person out of 100 are not able to pay their loans, pretty much. That's like less than one person out of 100 are not able to pay their loans with a 60% acceptance rate. So this is massive, right? So
like 7.5 people per 1,000, right?
Exactly, yeah.
Okay.
Which is incredible, right? Like this would be a massive good portfolio. So pretty much the way these scoring models work is that way that you have different scoring models. You can use plenty of them, but then you need to make sure that they correlate, and those are where the decision engines happen. And then the good thing is this happens in milliseconds, right? Like we're talking about it like it's a big thing, but it's literally 1 second decision is made, and that's it. So I think also it's the speed of it.
Okay.
Good. So I wanted to finish with this thought that we've actually discussed already, but I think in a nutshell, like thanks to all of these technology and machine learning, data science platforms, open banking, open data, and all of that, all of the consumer finance companies will be able to increase and improve their performance and reduce risk. So in a nutshell, what this is going to happen, the more we advance with more advanced technology and so forth, is that because we have technology, the loans will become cheaper and cheaper every day. It's literally the same thing that we were discussing about why is it, for example, in first world countries that they have a lower interest rate. It's because they have more data, they have more understanding, and they have more tools to predict what are the different risks associated with giving out a loan. So the more we advance, this will happen everywhere, not only in first world countries, but also everywhere, because now technology is much more accessible. Like if you think about, all of these algorithms and all of these machine learning things, in the past, for a company to build this up, it was incredible expensive, right? So that's why only big companies were able to do these type of things. Today, because of open banking and open data and infrastructure, now like every single company could have access to that. It is like the same innovation as I don't know, like if you think about AWS, right? So in the past, like setting up a server and setting up infrastructure to build up your platforms and everything was incredible complex, and it was incredibly expensive, and that's why you didn't see too many tech companies just popping up everywhere. But today, these are kind of software as a service. You just buy it up, have like monthly payments, and that's it, and you have access to it. The same thing is happening today in consumer finance. Like there's so much information out there that a lot of companies can access it. They can understand, they can implement some technology, and then they can make pretty much better decisions that will pretty much give out a cheaper loan to the customer. So in the end, while reducing the risk via technology is improving everyone's financial performance, both for the customers and for consumer finance companies. So, yeah.
So my question is, okay, so the interest rates will somewhat drop because, of course, the default risks will be lower, or let's say perceived default risks will be lower. But then it's usually bad for financial institutions when rates are too low because they're not making that much like net interest. So what do you think will be, the innovation here? Like what kind of products, or how would they be able to compete with each other if everyone is just, it's basically like a race to the bottom? where everyone is
Yeah.
somewhat going to be improving technology, but then each improvement is, it has like some marginal utility, but it's always declining.
Yeah, I think we briefly discussed about it. I think it all will come up to have dynamic pricing. I think this is going to be more or less the future, right? Like, which today not everyone has access to a loan, so we need to start with that, right? Like, you need to make publicly available consumer finance for everyone, right? So that's the first thing. Like, just everyone to have access to consumer finance in a fast way, and also everywhere. But the other part is that dynamic, because you have so much data, then it's not about a race to the bottom, but actually a race to the perfect interest rate for each individual, for each of the specific cohort or user that this specific user is. So I think, for example, high interest rates loans will always be there. I don't think they will go away, because the risk associated to it is much more higher. But at the same time, the other thing is also true, which is, if the risk is lower, then I will give you a lower interest rate. So I don't think it's specifically a race to the bottom, but actually a race to the most efficient number. And that requires for you to assess different data and make a decision that is specific to one individual and one cohort because of those X, Y, and Z, individual characteristics. So I think it's more a race to that individual, specific, targeted, pricing or interest rate, the way you want to see it.
Okay, well, looks like we are through here. So Bernardo, I'm gonna wish you luck with your job and to your company as well. And I would say to fintech in general, because we all need cheap money to go around and build businesses and buy stuff, buy homes. So I guess that's a good thing in general. So thanks a lot for your time and for your effort in preparing this presentation. And thanks to everyone who has been listening to us and who will be listening to us later. Have a good day.
Yeah.
Stay fit.
Thanks a lot, Alexander. Thanks for having me here, and also wish you the best in future conversations.